All right. Good evening, guys. Canna Tortoise Capital Nightly Strategy Podcast for June 19th, 2022. Let's see. Get my soundboard working here. All right. So just a quick update for the Creativity 202 course. We did our session this morning for the Eurozone. We were working on, we went through the introductory lesson today. Guys had done the work and they brought their true stories. We decided to record those. That session is now posted under the weekly check-in sessions, and so tomorrow night's gets posted here as well. And we'll keep a running set of those recordings as part of the home study course and for folks to refer to. There were some really good insights already on week 1 for the essential ideas. When is good enough good enough? A review of our works in progress and why that matters. We'll do the U.S. members tomorrow night at 7 Central and record that and post that there as well. And then the following week we start into the lessons proper. There's 6 big sections. Want it, get it, unlock your creativity, amplify your creativity, practice advanced creativity, myths, conclusions, and reminders. These are things that we've generated already with the pilot program about some amazing insights that were just too good to share. Plus, I've added in my own work in progress as I continue to build out the sniper course. I'm updating that as my work in progress. That is the focus of what I'm trying to increase my creativity about. That's the work in progress. And then I'm doing a 1-page note sheet as I go through the lessons, even the ones that I've written. I go through them again and I get my reactions and responses and reflections, and I'm producing a 1-page flashcard, which I then lecture about. And then those get posted. Those will get posted here as part of a rolling hybrid style workshop that we build as we go. So those of you in the sound of my voice that are in the Creativity 202, that's where you can find the sessions that we've recorded so far. And this morning's was 2 hours. That was very, very good. I gave about a 20-minute update on the current concept of the sniper, and it was pretty well received. This is the example of my note sheet from today. These were the insights that I got from doing the Fletcher portion of the exercise, and then these were the ones that really resonated with me off my own contribution to that lesson. And then the true storytelling story that I shared, my aha moment from this week, was the anxiety I was feeling about expanding the scope of the business to a wider audience out there in the world, and then sort of how I'm managing that. That was my true story. I use these flashcards here to describe the plan, prepare, execute, and assess of the sniper. So this is the plan of, in general, I went into some details about how we go about finding targets in the S&P 500 and ETF 200 and all currencies and commodities for targets that are in a compounded critical state on the basis of multiple time frame locations and 2 different measures of short-term volatility. When you find symbols that are in critical states from both of those sources, then you have what I call a compounded critical state. And I covered why that was important this morning. And then in terms of framing and executing, we're using these framing questions on the left-hand side to make sure that we're framing the trades in both directions. And then the concept diagram on the right side examines how we find things that are in these compounded critical states just before the market opens. And we don't care if they are fantastically oversold or on an incredible upward run or in an abnormal sideways quiet channel. As long as they meet our criteria for being in a compound critical state, we can frame them in a standard way using these framing questions. And then we execute those trades using one of the 4 standard sniper patterns, which have the common feature of being able to quickly get our trades to no lose plus dinner for 2, but also with the possibility of having large multiples in either direction if the higher time frames decide to support that trade and build on the initial momentum of our first trades. Then you get these large moves in either direction. Otherwise, you get small incremental moves that we can capitalize on. And that is the standard way of executing the trades, exiting the trades, and really the end-to-end process of plan, prepare, execute, and assess. And I covered that in about a 30-minute lesson today in the Creativity 202 course. And I will continue to update my sniper work in progress in that course for people that are in that, so that they can see the applied creativity of both Fletcher and true storytelling in practice. So there's that. All right, let's move on to the let's move on to our trade frames. As usual, we'll start with Chi Wing Chong and look at the broad sector comparisons using the slope statistic of the 30-period regression lines. So we're noticing that in the sell-off this week, everything came back to the zero line, that the temporary boost quickly rolled over. And now notice how tightly the correlations converge, that you get some significant differences in performance during upward markets, especially. As this starts to roll up, you get real distinction between the performance of sectors. But when everything starts getting ready to collapse, everything collapses together. Energy took the biggest hit, which we anticipated during the rollover from a Z plus 2. That's a 1-week price action there. Materials leading the way south with finance, only tech holding on a little bit, but really no safe place, no safe spaces. That is characteristic of bearish markets, when the normal correlations of bull markets disappear and everything converges. So there's a real distinction between the concept of diversification in bull markets versus bear markets. What you thought was diversified in the bull may not be diversified in the bear. And the main reason for that is that people are in bull markets are keeping their money exposed to equity risk, and they're trying to find the place where the money is treated the best. So it stays in the market, but it cycles between sectors and targets. So you get a real diversity of performance. In bear markets, people are pulling money out of the market. So it's not looking for an alternative equity or sector. It's coming out of the market altogether. And so everything goes down because the thing that you're selling is going down and you're not buying anything new, so there's nothing going up to create the divergence, and that's what causes the correlations to get so tight. Still seeing even the staples are rolling over. As the market rolls over, the consumer discretionary, oddly, is still doing a little better than the staples. You wouldn't think that was the case, except this may be a reflection of fundamental worries about the business cycle itself, that even conservative businesses are suffering from energy price hikes, and they get affected by that, and their margins are low and so forth. So no safe spaces. We'll take a look at Luke's frame here in the 5-minute Aussie. He's normally trading on 5 minutes, but he's got, let's see, he's going to a 60-minute look here, which is 12 times his normal 5-minute orientation. And then a 24-hour, an 8-hour, which is times 8, and then times 3 to get out here to the daily. And what he's looking at doing on this is trying to find those key price levels of support and resistance where if it breaks through, then he wants to be adding positions. Or as it approaches that, he's going to be prepared for sudden reversals. And you can see that the most recent move in the Aussie was up, has pulled back nicely. And found support right back where the previous SSC and COTA 2 triggered the nice run up. This thing has rolled all the way back to exactly that same price level. So now, just like here, we were prepared to go short or long from this critical state. Short or long is also indicated. And now you have a couple price levels for targets in both directions. And that's a tradable move. And if it rolls over, you cash it. If it goes through, you might add a second until you test and test. So we'll see how that rolls out on the 5-minute Aussie during the week. Now a series from Ken H. These are multi-time frame setups. So this is consistent with what I said before about using multiple time frames to find compounded critical states. Each one of these has a population of traders that are focused, some population of traders that are long-term buy and holders, that are looking at weekly charts, and then some population of short-term traders that are day traders, and some that are like intermediate swing traders. So it's normal for these guys to really concentrate on their area of expertise. And so when a trade in their look-back period gets to one of those critical states, overbought or oversold, they're expecting from that to be some sharp breakout or a reversion to the mean. In either direction, reversion to the mean or a breakdown. So as price starts moving towards those critical states, their rational mind is saying, expect something large and unusual to happen. Be ready. Then when it happens, these guys are prepared and off they go. But everybody that's not using that same time frame might get surprised by the fact that suddenly this very orderly move had a sharp breakout or a sharp reversal. And so they get surprised by that. And they say, aha, what was that? I don't know. And then fear and greed takes over, and then you start getting, instead of normal ranges, you start getting expanded ranges, and that's where the volatility short term comes in. So then if your 1 day and 5 day volatilities begin to explode, now suddenly the rational mind, which is concerned with location, links up with the short-term volatility mind, and you get compounded critical states. And these are 5 standard patterns we use in the sniper to identify typical breakout or breakdown patterns, and then we prepare those. So our plan is to find those things that are in compounded critical states. Our preparation consists of framing them in a systematic, disciplined way, and rehearsing that so that our execution is flawless, and then use standardized risk management, trade management, exit management, and then following up with rock-solid assessment. So what Ken H. is doing is essentially a form of the sniper style of generating targets, where he's looking at 3 different time frames. He's using weekly, daily, and hourly. Sometimes he uses 30 minute. And what we're looking for are those confluences of support and resistance, and taking a look at what volatility is doing to see if there is some kind of interesting idea or a critical state being entered. So that's what we're about to do now. This is his adaptation of that basic premise. Very sound. And I think it's fair to say that he would tell you too that his short-term and swing trading has really improved as a function of doing these weekly structured views of the market and looking at critical state trades in both directions. And those of you who have the research weekend workshop can see his testimony on that. You can see that video on our homepage at tortoisecapital.net as well. Well, Nick, there's nobody stopping you. Or is there? All right, so the first one we have is AXP. This is part of that finance sector that's rolling over. And what I'm noticing here is this combination play. Notice how the upward moves are small compared to the large downward moves, and the downward moves are getting larger. And notice how good the PSAR is at identifying and keeping you into trades until it tests and then resumes downward. So that PSAR is a trustworthy dashboard instrument. A 1-2 recovery on the daily, and it finished near the top, which sets up exactly this little SSC. Now, he did not take that trade and hold it over the weekend because he doesn't need to. But what we have is a 0 state on an hourly breakout here, where he's taken the last hour and said, look, if we say that's the neutral zone, any breakout above this is probably going to break out through here, and then you have not much resistance at all, And so there's a real chance for this to make a surprise run, only we won't be surprised because he'd be ready to be long either here or here. And then the breakdown is easy to see because you already see what happens when this thing breaks down. It breaks down fast. So people that don't frame the trade in both directions might be surprised by an upward surge. We won't be. And any breakout above about 145 would be a 1, 2, 3 entry, and then your target would be back here, probably the Z1 or Z minus 1, then the Bollinger Band mean, far side. As you see, he's got marked off here. Peak of the dragon. This is over on the weekly. We just noticed that when the finance sector is doing well, it does really well. Then it has gotten into a period of oscillating, perfect for swing trading. And then notice what happens as soon as those previous boundaries break. When this boundary broke to the upside, you got an immediate run up. And then it couldn't hold, and it immediately ran down, and you got a panic and recovery. When this boundary then broke, you get an even larger move up. And when that broke here, you get a downward move. So you're getting expanding volatility. That's a bad sign for long-term buy and holders, but is great for swing traders. So we're poised right at the bottom where you would not be surprised to see a recovery or a big failure. So AXP looks to be a compounded critical state with a clear trading plan on where to go. Walmart in the staples is not immune to this pain and suffering and the economic slowdown. Notice again, once again, when those critical support levels get broken, notice how each one of those was getting deeper and steeper. So now when this one breaks, that's the least, I'm not going to say that's the least surprising move, but it kind of is, that when those break, that big downward move really gets punished. Multiple stages down. Held support, holding support in a 5-day, 10-day range, 30-day range. So this is also the 150-day range. So if that collapses, then every population that is trading Walmart, whether it's day trading, swing trading, or position trading, if that 118 breaks, then all three of those populations, individually and collectively, may be induced into a fear response, which drives us down with a great big sudden spike in the same way that you saw that sell-off. So the breakdown is easy to see. The breakout to the upside, a simple 1, 2, 3 units of reward just to get to the top, that's a tradable short-term tactical move. Now, that is what we mean when we look at this execution trade here, is this initial move out of the critical state is the one where we are framing uh, 2-to-1 reward to risk ratios, and if this breaks down, 2-to-1. And then if those other time frames decide to act on panic or greed, you not only get that initial burst where you made your money, but additional momentum comes in, maybe, and starts to pump this up and generates more momentum until you get these outrageously large moves. But it starts from a disciplined approach of finding 2-to-1 reward to risks on our time frame with the possibility of expansions. It's the fact that it is in a compound critical state where multiple populations that are each looking at their own look-back periods and which are affected by volatility have anticipations and ready to go. So when it starts tripping, now suddenly you get massive follow-through, and that's where the surprise movement comes from. Each one is not surprised on his own, but is surprised by the vigor of other people coming in and adding gas to the fire. That's why the compounded critical state is potentially such a good payoff. So that's Walmart critical state. IMAB, a healthcare and biotech company. And just like the whole healthcare sector, we saw this with the Godzilla patterns with healthcare real estate, Peak and ARE, which are still active in our discipline. They have been experiencing these huge sell-offs, which gives you the weekly, the daily, and the hourly critical states. And now notice when that holds, you get these remarkable moves. But notice when that short-term, those short-term buyers get done, they didn't break through this previous support level. Maybe that means these guys on the daily did not come in and push it higher. But it's so close that it could be testing, so we wouldn't be surprised to see it come up to 14. So there's a tradable move of about $3 in there and a little risk box of about $1. So there's a 3-to-1 move available up into here. And then there's also a 3-to-1 move available down to test the previous swing low. So if the move from here simply does the tactical play and stops, you get a 3-to-1 in either direction. That's what a critical state means. But if the longer term buyers are saying, oh, this is still a buy on dip opportunity and it really belongs up here, you may have people that are willing to buy it as high as 17 and they keep coming in to buy this thing. So this little 3-to-1 could end up becoming a 10-to-1. That's what we mean by by fractals and when higher time frames confirm the direction of the trade. If they don't come in and this thing just comes up here and starts rolling over, then a reversion back to the mean is the next play. So you could very easily see an upward surge for 3-to-1, holds, starts failing. Now, if you in your heart are believing that it should be up there, you might reject the information that's available to you that this thing is failing. And you might try to hold it all the way down and use the force of your will to send it back up. Let me know how that works. That feels like a lot of work. So let price be your guide. So IMAB, compound critical state, speaks for itself. XLB, we saw this being among the weakest of those rotational sectors, and you can see what that looks like as it's played out in those big gap downs and sell-off that are just trying to find support around 75. That's what this looks like, 2 days of trying to find support. So we just call that a critical state. And then if it breaks out from here, then that's not much resistance at all. There's no price action in there, whatever. You don't get resistance until 78, which means that's a $3 move on about a 50-cent risk box. So 6-to-1. And then the failure here is also easy to see, because if this starts failing again, then everybody that sees that is going to say, oh, the era of normal oscillating markets is over. Now all of this brilliant gain that we were enjoying from way down here are all at risk, and so that would contribute to panic selling. And then you'd look for areas of support and congestion and start laying those out as price targets. So this, a breakdown from 75 could get you to 70 pretty quick. So the downside on this is easy to see. And if this happens in XLB, it won't be alone. Everything else in the market's going to be crushed because the basic material sector has actual things, actual commodities that have intrinsic value, things that you use to build roads and buildings and all that stuff. So anyway, this is why the metals are so interesting to us right now, because you have materials and then you have the subset of the metals, which is like a leveraged play on materials. And so that's why we watch Alcoa, U.S. Steel, Cliff, Nucor Steel. One of those things is going to be moving huge. So XLB, perfect. What's nice about XLB is that as a percentage of the S&P, it's so small, whereas tech and finance are really large, and it takes a lot of people with a lot of money to move those things around. XLB is a relatively small sliver of the overall S&P, and so it can actually move on its own significantly, which is what makes it a great trading vehicle. And it has a futures and options on it as well. So I like XLB. NRG, independent power providers in the energy sector. And you can see just how these things oscillate as a function of oil and politics. But boy, you just have to say this is unusual behavior for this thing to roll from 47 all the way down to 36. That's an extraordinary move. And this is a place where you wouldn't be surprised if it held support, because the last two times it did, and each time there was a significant response. So Ken H has organized a little trade frame here that says, look, if it does start going up, I could see it getting to 38 and then 39 pretty easily on about a 30-cent risk. So that's like 6 to 1 on the upside. And you shouldn't need much persuasion to say if this breaks, the next support level is down here, which should be rock solid support, because you get a lot of people buying and selling right there. So 33 is in play, which is a $3 move on a 30-cent risk, is a 10 to 1 trade to the downside. So you got to like NRG. Under normal circumstances, not a great trade for long-term buy and hold. Probably pays a dividend. But at this moment, pretty interesting. XOM Classic. We smashed this one on Friday. As part of the sell-off of the energy sector from 105 to 85. Wow. Cratered. That's how fast the world can change in 5 days. There's your 10-day low, 10-day high. There's your 5-day high, 5-day low. Look how extraordinary just in 5 days. It erased 30 days worth of gains in 5 days. But it's showing signs of holding down around here where it held before. So once again, like a broken record, critical state, critical state. Yeah, in the battle between big oil and big government, you better bet on big oil, because oil is what allows you to turn the lights on. Government can only tell you to do things, but they don't have any motive power themselves. PBW, clean energy. This is a beautiful trading thing. Every time this thing bounces, I'm ready to smash it to the downside. Easy trade. If it does start breaking out to the upside, 51, this is pure trade. There is no fundamental justification for it for the next 3 years. This is a pure tactical opportunity. PBW is a great trade for that purpose only. You cannot believe in it, but you can surely trade it. Tesla, the most important stock in the world. Also, see how quickly the true change. This is at the start of the Twitter shenanigans. And then now suddenly the world got tough. So the trading range now is between 770 and 600. And he's near the bottom of it. So the bottom side is easy to see as a tactical short. The upside is the one that probably pays you better. Standard trading play. You can see us trading that thing every day for the last 30 days in the sniper trade of the day. ARC Innovation, just how the mighty have fallen. Boy, that inverse ARC fund, the S-ARC, it's got to be doing great. I don't see any hope for them other than these short tactical plays, but that looks like somebody that's lost their magic. And magic requires other people to believe in you. She believes in her stuff and in her discipline, which works at some times. I mean, notice this. That's when it was working. But when people stop believing in your magic, that's all it takes for that to happen. So, strong support. This is the natural rollover point. Perfect for follow through in either direction with about a 50-cent risk box. Nice work. Finally, AT&T, sort of the opposite of groovy. Strong support and resistance. It's pushing that right now. So it has to actually get through that and above that to really be upward bound. The easier trade to believe in is the downward fail down to here. But you can see strong support, strong resistance right in the middle of this congestion zone. So this is really just like a fence sitter that's ready to break up or down with equal likelihood and large-scale move on about a 20-cent risk box. What a nice trade that's going to be tomorrow. All right, that's everything I got for today. We'll get you back to work and ready to rock tomorrow.